So, yes, I mean, it was obviously good news. Last week, I mean, it was largely news that we expected. I would say there was a small amount of extra news in it on services inflation, but it was largely news that we expected. And as we set out in the monetary policy report 3 weeks ago, we expect a little bit more of what I would call these unwinding of last year's external shocks to come through. We're not going to get another one like last week, though. That's the last of those base effects to come through. But we think there's a bit more to come through. Certainly on food, I think there's a bit more to come through. And that will come through really by probably sort of the end of the first quarter of next year, probably a little bit beyond that. After that, I think we're unwinding really what I would sort of call more the what we don't call the second round effects, the degree to which these shocks have become embedded more into domestic price setting and domestic inflation. Now, as you can see from the recent voting on the committee and actually the distribution of votes of my colleagues here, I mean, we do take different views on this. If I could set out the balance sheet of those views to start with, we've seen, I think, slight downside news on sort of inflation this year. It's going to end the year a bit lower than we thought we would, but not much. We've seen a weakening picture of demand in the economy, I would say. And we've seen some weakening on the quantity side of the labour market. A little bit hard to read at the moment for reasons we may come on to. On the wages side, I think I can see some signs of it beginning to come off, but it is still well above where we thought it would be, and obviously well above a level consistent with the target. Now, looking forwards, I think there are, you can take obviously several views of that. The view I personally take is that I think we have seen signs now that we are on target. We're on target to come back to 2%. I think the current setting of policy is restrictive, and we've used that word, as have other central banks actually, to describe the fact that it is, in a sense, causing a restriction within the economy, which should bring inflation back to target.
But we've reached Table Mountain in terms of interest rates, so
Yes, but Table Mountain's quite a good analogy in the sense of, there's a case now for, I personally think, for holding the rate where it is, and we've been quite careful in the language we've used. We've used the term for an extended period. But the risks, and I think the committee are all in one place on this, the risks are on the upside still.